Hey everyone, this is Richard Yi. Today is December 20th, 2011. So just an hour ago, my last final exam, calculus, has just finished. So now that I have some time to cover some of the news that I wasn't able to cover in the past 2 or 3 weeks, because I was busy preparing for my exam. As we know, early this year, the Chinese government attempt to cool down the real estate prices by raising the reserve requirement multiple times. And after all, it's just like 4 or 5 percentage point move in the reserve requirement. And now, Chinese businesses are screaming for lower interest rates. And this definitely shows how vulnerable the Chinese economy is, because businesses can't even take a 4 to 5 percentage hike in the reserve requirements. You see, the reason why Chinese businesses they just can't survive without a low interest rate and a loose monetary policy is precisely because Chinese government undervalue its currency against other major currencies, right? Because Chinese government wants to boost export. Well, how do you do that? Well, in the normal economy where the exchange rate are free to fluctuate, right? Export won't be artificially boosted. So, sure, the country has some export, but it's not going to be relying on export that much, or I should say, the export will not be artificially stimulated. However, in the Chinese economy, the story is totally different. Since the yuan, the Chinese currency, is artificially undervalued, so that means that's like a boost to the Chinese export sector, right? So the entire Chinese economy has, in the past 2 decades or so, has transformed into a total export economy. So that means what does that mean? Well, that means Chinese government can't do much in terms of the changing the loose monetary policy, because if it changes, the Chinese export sector is going to take a big hit, and, and if it takes that hit, right, the Chinese economy is gonna shrink. So that really limits what the government can do in terms of the monetary policy. And there are two policies that the Chinese government should pursue if it wants to solve this problem in the long run, right? So that is to say, the Chinese government has to liberate the lands. By that I mean, give the property rights back to the people, right? Let the market decide what land are worth. Or if you do that, the price of the Chinese real estate will come down. Why? Because the supply of housing will gradually increase, right? Because there's such a high demand for it. So as the price of the Chinese real estate cools down, that gives more room for the Chinese government in terms of monetary policy, right? It doesn't have to contract as much as it would, attempting to cool down real estate markets. And the second policy is that Chinese government should gradually um, decrease its intervention in the foreign exchange market. So, in the sense, yuan will gradually appreciate. And by doing that, that's like a short adjustment for China's export sector. Sure, in the next 5 or 6 years, if the Chinese government pursues that policy, sure, the export sector will take a hit, right? But that's a good sign, right? Because Chinese economy now is sick. It's addicted to that drug, and that drug is cheap yuan, yuan undervaluation. So if you want to have a healthy economy, that is to say, you produce a lot of goods for the domestic citizens, and it doesn't have artificially boosted export sector. If you want to have that kind of economy, you definitely have to um, gradually release your intervention in the foreign exchange market, and gradually the export sector, the profit will shrink. Right? As profit shrinks, new firms they stop entering the sectors. Instead, they start making stuff in the other sectors. So capital withdrawn from the export sectors. So of course, the second thing I will talk about is in the European Union, and I think there will be two likely fate, although one is way more likely than the other, but two likely fates that the European Union will end up in. So first of all, we have to recognize what really is the problem in the European Union. It's not those bailout funds can't get enough money. it's not those finance ministers. They can't reach a conclusion. But the problem is the deficits, right? The deficits in European Union are running out of control. So most of the members they're running like really huge deficits, and only like two France and Germany are supporting them. And the reason why those poor nations in European Union are yelling for bailouts and all that, and they don't do it themselves, is because they cannot print euro freely, right? If they can just print euro as much as they want, you know, they're not gonna have that problem, right? It's just like the United States. The United States can print dollars as freely as it wants, right? You can, the Federal Reserve can purchase treasuries to finance the government. So I mean, as long as the debt limit is raised, I mean, no problem. But it's different from in Europe. In Europe, I mean, those countries they can't just print out a bunch of euro and buy those bonds, right? Although they're discussing to do it, but it's under a lot of limitations because of the membership. It's not like a country has a lot of membership. And the likely fate of the European Union is likely that it will collapse. Why is that? Because the fundamental problem, that is to say, the debt and deficit, I mean, it's not addressed at all. I mean, all those nations are seeking like bailout money, and the politicians they don't have the guts to cut those deficits, right? As long as that process is not undergone, then there's no way in the long run rich countries like Germany or France will continue to bail out those in debt nations. And it will reach a point in which the Germans and the French will tell those in debt nations that, hey, look, we are not going to keep bailing out forever. Right? Sure, I mean, and we'll just quit the eurozone, and we just use our own currency, so we don't have any financial bond to work between us. So I mean, you're on your own risk, right? Your risk no longer affects the entire eurozone. Well, if that happens, then Greece is definitely on its own, right? Because if the eurozone just collapses and every country uses their own currency, I mean, they have a less impact to each other than in the entire European Union because they're using a unified currency. And the second likely fate, and I think this one's more likely than the first one, is that the European Union will hold together, but those indebted nations like Greece or Italy, they will be kicked out from the European Union, right? Because instead of letting the European Union collapsing, well, a more favorable way is just to kick them out, right? Because think about it, if you're gonna let the entire European Union collapse, that means euro has to collapse, right? Then the problem is how you're going to reevaluate this currency, right? If Germany returns to using mark and France using franc and all other countries use their own currency, then you face the problem of how you're going to reevaluate this currency, right? That's really a big problem because under euro, I mean there's no exchange rate between boundaries. There's 1 euro in Germany is the same as 1 euro in France. So if you all of a sudden switch to their own currency, they will face the problem of revaluation. Even though in the long run, revaluation can be done by speculators, but in the short run, that would definitely cause some trade imbalances. And it'll be really interesting to see how this thing plays out. I think that's it for today, and I'll be going back to Vancouver in a couple of hours, so I'll be better packing. So anyhow, this is my video blog for today. Thank you for watching, and I'll be vlogging again very soon. Guys, take care. Bye.